course, January 2020, what did we have around us? I mean, very simply, we had Donald Trump seemed to be a shoo-in to get re-elected. Something heinous would have to happen to stop him get re-elected. Maybe, just maybe, who knows? We had Boris Johnson had obviously just won a resounding majority in the UK to really to take the UK through its Brexit, okay, and that was planned, okay, in December later this year. We saw the European Union under the state of quantitative easing, massive amounts of money coming in for quantitative easing here already. 20 billion a month was coming in, and that's something that Christine Lagarde inherited, okay, from Mario Draghi. So this was the backdrop, and to be honest, heart of hearts, looking at 2020 for our clients, I was sat there thinking, this is pretty much a shoe-in. And of course, with the greater degree of relationship between the US and China, as they were moving through phase one of their trade talks, trade negotiations, a long way from the trade wars that had really hampered us, okay, in end of 18 and early 19. So it looked a pretty confident, okay, stance that we were taking for 2020 and forward. And then, of course, what a difference a few weeks makes. And we move into this situation where equities, and let's just focus on this. What I'm about to show you now is the impact of the equity markets, not the property markets, not the cash markets, not the fixed interest bond markets. So let's just have a look at some of the equities for a moment. Some of the main players here. Number one, because we've got, and I'll just drag my mouse over so I can, okay. Here we've got, okay, the DAX, which is obviously the German stock market. Germany being one of the main, okay, exporters of the world. I think it's the second or third largest export economy in the world. And you think the size of Germany vis-a-vis China or the US, but they don't have export a pound of goods there for sure. So Germany, the heartland of the Eurozone. We've then got the SMI, which is the stock market of Switzerland. And you already start to see this Swiss safety play. We're never far from a Swiss safety play. And certainly not just because the currency is seen to be as a safe haven. And of course, being a safe haven is that, you know, in the times of crisis, people go to gold, people go to the Swiss franc, maybe the Norwegian crown, okay, maybe even the Canadian dollar, okay? And of course, in the times of absolute need, the US dollar. And we certainly saw the US dollar play in the early phases of this rollout. But with the Swiss franc, just looking at some of the dynamic they've got there, because in Switzerland, their interest rates are negative 0.75. So of course, when typically people see this situation coming and they go to, okay, their normal trade pattern, let's just go and buy some Swiss francs and let's just go and send our money to Credit Suisse, UBS, and we'll harbor it out there. But when they realize that money is negative 0.75, plus the Swiss francs are charging them quite some penalty and costs for keeping their money there. So what those clients have done is then just rolled it straight into an SMI ETF, which is an exchange traded fund, okay, on that basis. So they're just buying the index, it's in Swiss francs, and as a result, that's given the SMI a bit of a tick to the upside, okay? We then come across to another, okay, real expansive market right now. And we're going to come on to some of the winners and losers, okay, in the market from various companies and sectors. But what we can see here is the bite of the NASDAQ, okay, and the pullback of the NASDAQ. And if we're just dragging my mouse across here to think that, okay, we're probably some 10% down from the top of the market on the NASDAQ. And boy, isn't everything technology today, as we can see with us communicating on a Zoom piece of software, and we all know about, or maybe we don't know, but should have heard about Zoom, okay, and their equity price and how it has gone, okay, gangbusters, okay, in recent times. Okay, so let's just then move on to some other index, and they're all pretty much same, but different. But again, this is the worldwide equity market, okay, and how these markets have responded. This is the FTSE, okay, obviously it's the Financial Times 100 share index of the UK. And the FTSE, of course, has been less dramatic from a fight back. I mean, very much more of a sideways trading strategy here, slightly upwards, of course. But what has the UK got that the others haven't? Number one, they've had their Prime Minister, okay, that at some stage was a 50-50 whether he was going to live or pass away, heaven forbid. But also they've got the headwinds of a Brexit to go through as well. So not only have they got, okay, a country on pretty much lockdown, they've had a very, okay, seriously ill, okay, Prime Minister, and they've got Brexit to come. So less appealing maybe, okay, from an investor. And we see the Dow Jones next to it here. Okay, the Dow Jones, of course, you know, the Americans, they don't have bounce back quickly. And of course, we've got, you know, a big driving market today as well. All equities across the board are up typically 1 to 1.5%. Again, a sea of green, okay, out there, okay, looking at the Bloomberg okay, terminals earlier today. Okay, so you get the theme, okay? We've seen the bottom circa 7 weeks ago, and let's just look at this from the Nikkei over here as well. I mean, this drop here was negative 30 to 35% in 3 weeks. Okay, so week 1, week 2, and obviously when week 2 happened, that's when we had the, okay, trap doors opened and oil fell through the floor, okay, going from its $55, $60 a barrel, okay, right down to below zero, okay, at some stages, just again, to use that word second time, but unprecedented for oil to be at zero or minus, okay, from a cost perspective. But since then, we've seen, okay, the mother of all rallies as well. It's the biggest rally that's happened since the Depression, okay, in the 30s. So there's definitely life in equities. Absolutely. There is definitely, okay, the FOMO, yeah, the fear of missing out. Many clients, and include, okay, United Advisors clients coming to the table, okay, most definitely wanting to see this as an opportunity and wanting to come in and to increase their savings, okay, or indeed to put more investments into their programs, you know. Okay, let's have a look at some then of the various sectors, okay, that are in the market here. And this is just the list here of service sector, okay, trouble and strife, as they would say in London, but quite interesting to see, okay, just from a viewpoint that, okay, some of the core sectors, so education, package holidays, okay, audiovisual, okay, hairdressing, okay, hotels, restaurants, catering, but of course with the social distancing rules and the impact of social distancing here. So of course we can see just on, okay, hotels and restaurants here, we can see Spain dramatically, okay, going to be impacted from their percentage of GDP on this scenario. So let's look at the education here. US, obviously big education. Okay, we've definitely got many of our clients that have offsprings, okay, children, okay, sons and daughters over in the US studying. Big impact. Of course, it's very costly. Okay, and how they handle this situation going forward, okay, potential to really harm them, okay, with all the very prestigious Ivy League colleges over there, you know. Not so much in the UK, but I'll tell you, the package holidays, boy, in the UK, don't they love a package holiday? When you think that, yeah, the UK, okay, maybe the kings of package holidays. In the US, not a drop, don't have a package holiday there. France, very little, okay, also Germany, very little. But yeah, from that perspective, big on the package holidays there from the UK. So just as a bit of a round robin here to see exactly, okay, the sort of sectors, many staff being, okay, furloughed, okay, many staff being out of work, okay, particularly in these smaller organizations or smaller, okay, smaller chains, you know. Okay, what's happened since this tsunami has hit us and across the, not only the healthcare sector, but also across, okay, the economies? Of course, there has had to become a huge, huge, huge fight back. And I just want to spend some time here looking up, okay, yes, we can look at the slide, but this is about quantitative easing. This is about support. This is about, okay, the bank of last resort coming to the rescue. And make no bones about it, this all happened, and we'll come on to the global financial crisis, because I think it's quite important that we compare the global financial crisis, because you know, many of our clients are in their 20s, 30s, okay? Many of our clients maybe don't remember, particularly from the marine side of it, from the mariners, maybe many of them don't remember the global financial crisis and Lehman Brothers going bust and what that meant. So as it's the most adjacent, okay, crisis, I think it's good to compare and contrast. But what happened at the end of the global financial crisis is that every major central bank, without fail, okay, went and effectively danced with the devil a little bit from a stimulus perspective. Because what they did is they went to raid their own cookie jar. They came up with this, okay, methodology of economical stimulus that hasn't been used since the 1930s after the, okay, after the Depression. What that meant with Keynesian economics, okay, and he was the particular economist that came up with this this strategy. And I guess to liken it to, okay, current day, it's like playing Monopoly with your family, and I'm sure many of us have done that, okay, in the lockdown period of time. But when the family go away and have their tea breaks and pee breaks, maybe the banker, okay, the central bank thinks, oh, maybe I'll just borrow a couple of hundred out of the bank. And effectively, when Obama, with the Central Bank of America, started to print dollars by the trillion, okay, and he did quantitative easing round 1, round 2, round 3, 7 trillion worth of dollars. Meanwhile, on the other side of the world, okay, nearly on the other side of the world, okay, with Angela Merkel and the ECB, chose not to go quantitative easing, but the other route to try to tackle the problem, which was to go austerity, to cut public spending, okay? Holes in the roads. Let's not invest into healthcare, heaven forbid, okay? Let's not start new, okay, projects to expand the runway, okay, or to build the new railway, okay, network, or improve the motorway systems. Let's not do that. Let's pay our debt down. Of course, if we were looking at those two strategies, most definitely quantitative easing won the day. Even though it cost the US $7.8 trillion, and they got it wrong on 2 events, they had to keep going, and that was Obama, okay, and Bernanke at the helm in those moments of time. So, of course, the US have done extreme quantitative easing. The UK have also gone to quantitative easing, okay? The Eurozone were doing quantitative easing, okay, before this COVID-19 crisis, you know? Japan with Abe over there, the president, Abenomics as they call it, okay, loves the subject matter. So let's just look at the world right now. Once you have, okay, raided the cookie jar and printed a load of cheap money and got it out there to support businesses and to enable those businesses to merge, acquire, to expand, then of course, coming to do it for a second time, it's like a click of the fingers, okay? If you've done it once, you're more likely to do it again. So what we see here, okay, sizing the required policy response. So this is what's happened, okay, from the various central banks. And we look at it. This is as a percentage of their GDP. GDP is their gross domestic product. From a corporate perspective, look at it as the turnover, okay, of the company. Of the country. So as a percentage of Italy's turnover, okay, they've come in at over 20%, okay, basically loan guarantees. So they're guaranteeing loans. When companies like in Italy, Pirelli wants to go and borrow money, unlimited supply, fill your boots. Generali, fill your boots, okay, on that perspective. Ferrari, fill your boots, okay? And we're looking at Germany, okay, just a little bit above 20%, okay, the US, okay, 18%, something in that manner. But just imagine, okay, what that means is that the US have come up with 2 trillion, okay, for big blue chip companies, the Boeings of this world, okay, most definitely. Huge organizations there needing supply to pay for furloughed staff, etc., and of course to stay in business. They've also come up with $480 billion, a further $480 billion for small and medium-sized organizations. Just again, okay, third time I'm using unprecedented times for them, okay, within the click of a fingers to go back to quantitative easing, you know. Japan on this situation are late to the game because they're a little bit behind the curve from Western Europe, okay, with the COVID virus. So they're currently starting their lockdown. They're like a couple of weeks into their lockdown scenario. But Abe's come out with words right at the start: whatever it takes, unlimited support for businesses to keep people employed. We will not go broke through this process. Okay, President Abe's words there. Euro area. Okay, well, I know we've got the face-off right now between, okay, the Germans, okay, and the ECB, okay, and obviously Christine Lagarde and the ECB. She's got, of course, the Eurozone has got its growing pains because they need to get 27, okay, signatures to agree anything, okay, before it can get pushed through. But there's talk of COVID bonds, there's talk of, okay, virus bonds to come out to further support. But Germany in itself, okay, have funded 780 billion, okay, support package to come to rescue, okay, in these times of need. So huge on that side. So the quantitative easing that's been brought to the table, okay, huge. Big business, okay, or it's giving the hope that big business will not go broke through this period of time, even though right now in Europe we have 40 million people that are out of work, okay, or furloughed. Okay, in the US, they're currently just over 20 million, currently getting, okay, still further millions of of application for Social Security on that perspective. So bearing in mind that in the US, it took them 10 years to create 2 million jobs. Okay, they're currently negative 20 million, okay, in the matter of a month and a half on that perspective. Just really take a breath times, you know. Okay, so to try to put a little bit more of a little bit of a view on it, many parents out there, okay, me included with my 3 daughters, and maybe some of you recognize some of the pictures in this screenshot here. If any of you have read the book, which is We're All Going on a Bear Hunt, as the name suggests here, it's quite a famous book, okay, written by a German author, but We're All Going on a Bear Hunt, and I thought it also, to me, reminded of, okay, when we had lockdown here, firm lockdown in Madrid, and when we could go to a light lockdown and we could go for a walk with the family, etc. Maybe it just, okay, threw some of those connotations there, but okay, you know, you can't go over it, you can't go under it. In this case, okay, it's a lake, you've got to go through it. And with this virus, there doesn't seem to be anywhere to hide in the world, okay, southern hemisphere, northern hemisphere, okay, it seems to be marauding through most countries in the world, and therefore we've got to go through it. And for those parents out there, maybe that there is some, okay, link between that and the bedtime stories you used to read or still do, okay, read to your children, you know. Okay, let's move on to some of the winners that are out there then, because in any market collapse, we see, okay, winners and losers, most definitely. I think just from seeing on the screen this morning, but for example, Amazon, year to date, okay, so not even going through the rise that it had through early January, but Amazon year to date is up circa 35%. The biggest retailer in the world, of course, Bezos, the El Presidente there, is very well publicized with his recent divorce, etc. And of course, okay, the biggest counterpart or competitor, I guess, Alibaba over in China, the China version of it, you know. Zoom, of course, the piece of kit we're speaking on here today, using the Zoom link. Johnson & Johnson happened to be the biggest manufacturer of pharmaceuticals, okay, and particularly with paracetamol in the world. And really, that is for the COVID-19 virus, for all of the, okay, less impacted people with it, okay, people with very mild symptoms, take the paracetamol, okay, rest and relax, quarantine for 2 weeks, you know. So of course, rocketing from their side. Roche, okay, talk about testing, okay, I know the UK has done the big deal with Roche upon all their testing kits, and of course, they haven't got enough hours in the day to make those. And Netflix, when we've been on real hard lockdown, of course, we've all been binging, okay, and watching our series there, okay, from various genres, okay, and likes and dislikes there. So some of the winners there, and of course, there are many, many more. This is also one of the ways to look at it from, by investing with a fund and by using a fund manager, okay, and the fund manager is designed to sell the losers, pick the winners, which of course adds even more fuel to these winning, okay, sectors and also winning particular companies. Now, on the flip side, let's just have a look at some of the you know, unluckier organizations that are out there. Of course, as if Boeing didn't have enough problems, okay, the 787 Dreamliner, all the problems are very well publicized there on that perspective. Of course, linked with Virgin, okay, over in Australia, okay, Virgin Blue, okay, gone. We also see Virgin Media in the UK now, okay, looking to have a big merger, or maybe that they're actually being gazumped and taken over. I think it's by O2. Again, Virgin looking on very, okay, weak ground. What's going to happen to Virgin Atlantic? Okay, is the writing on the wall from that and many other airlines? Maybe. Of course, the picture of an oil rig there, we could have put up many, many companies, and Chevron, Texaco, BP, okay, Shell, etc. But when those oil companies and their raw material goes down to the cost of zero, out of the game. And of course, we don't have a suitable, okay, power-packed energy source to get back, okay, over and above all. Yes, Tesla, brilliant, okay, great-looking cars, okay, but we don't have the hydrogen cell. We don't have something to replicate the oil right now. So oil will come back. From a speculator's perspective, it's almost like a blind man's shoe-in, really, you know, investing into an oil ETF. Okay, why not? Okay, makes good sense, providing you've got some time to see this through, of course. Sport, NBA, oh, I love my sport. Okay, my feelings in the lockdown period as I watched all of the various, okay, football leagues, soccer leagues, cricket, rugby, everything else that's gone with it. And of course, we see the Bundesliga maybe coming back. They're in training now. Looks to go ahead in a couple of weeks, and maybe we'll get some football back in the UK. Who knows? But until then, wipe out. Booking.com, I don't think so right now. Hertz also yesterday, fresh. We put this on overnight here because Hertz, okay, big name brand, went into Chapter 11 yesterday, okay, looking to fend off its creditors. And of course, if no one's flying, airports are closed, okay, no one picks their cars up from the airports anymore. And it's one of those, okay, aftershock scenarios, okay, out of the game looks like, very difficult to come back from that situation. Also Primark, because we put Primark up there, that's a high street retailer and it requires foot flow rather than, okay, being so well prepared like Amazon, okay, and Alibaba, okay, so high street, okay, not as we know it. Okay, so looked at some winners, looked at some losers, just to touch on the benefit of having a fund manager, okay, to substitute the losers, okay, for the winners, okay, to ensure that the funds can remain, okay, upon as positive a strategy and trajectory as possible on that side. What was originally perceived as a containable health scenario? Yeah, it was a virus, it was a flu. Okay, of course, a flu, we're going to get a jab and no problems will be over it. But of course, that's morphed, okay, out of all control. This is not a flu, this is a pneumonia, okay? And anyone that is of the wrong age, okay, weight, health, okay, history, okay, this is obviously, as we can see, with majority of large-scale countries have got tens and tens, 20, 30, 40 people on the mortality list. So not to be messed with at all. But when debtors, okay, are struggling to meet their commitments and investors sell their assets to meet their various demands of their finances, unfortunately, the global recession is inevitable. Of course, a recession, the true word of a recession is that it's too negative, okay, reducing, okay, global domestic product. So when the GDP reduces for 2 quarters back to back, it's classified as a recession. So there's no doubt we're in a recession, clear. I know we've got Q3 to come and that will be definitely, okay, a drawdown there. But unfortunately, the global recession is now inevitable, okay, with the markets trying to understand the depth and the length of the downturn. And let's just look at this. And I was relaying this to a client yesterday, and I remember my shock of seeing those tsunamis that came in, okay, across the beaches of Bali, okay, from the security cameras in the high-rise buildings there, and just watch that tsunami come in, and you see cars floating and the screams and the human loss, etc. And of course, yes, that's the massive intake of breath, and it's like, you are kidding me. What is that? Okay, and we saw it over Fukushima as well, okay, in Japan, and when the nuclear power station was there, was awash with salt water, and that's not a good, okay, combination either. But it's not until that water, okay, resides, okay, the tide reduces, then you see the true devastation. And this is what's happening right here, right now with us, okay? We've had the CV hit a shock. We didn't get enough notice. It came into North Italy. We know that. It's coming to, I'm in Madrid here, of course, the devastation here, the lockdowns here, okay? It took us very, very quickly. But it's not until it goes away, until we'll know the psychology, okay, of the human being, of the human race again. Do we want to go back into groups? Will we go back as normal? Will we sit in a packed restaurant and bar, okay, and enjoy the ambience on that side of it? Will we be cautious? Will we get back to it eventually? Will we be able to travel on a cheap airline, okay, or an expensive airline, okay, aisle 3, packed in because of low-cost flies? Who knows? Okay, what's the world going to look like? We won't know until this has passed. And of course, I'm going to come on to a moment. We have to give science a chance, but science isn't there right yet. Okay, so economic activity has been temporarily, well, life has been temporarily put on hold. It's a timeout central, isn't it? Capital T. On social distancing measures, okay, have been implemented, of course, you know. So first in economical impact. Second economical impact, when equities have such a big fall, and of course, when those equities and those huge blue chip organizations that are also very used to paying such a large dividend to pension funds, okay, then of course, Shell, upon this next slide, when organizations stop paying dividends, that means pensioners, semi-retires. We have many clients, okay, I myself have many clients that are semi-retired and full retired, okay. Many of those clients are enjoying funds that look towards buying big equities that pay high dividends, you know. And of course, if those companies are not going to be paying dividends, we need to really look constantly at those managers and make sure that those companies are being exited stage left, and that new companies are coming in that are continuing to pay dividends, like the winners, okay, not necessarily the short-term losers on this side, you know. So other impacts here coming through to the market and obviously to our clients, you know. Okay, let's have a look at, okay, the future. And of course, trying to focus on the future. No one can see the future, okay? I certainly can't see the future. All we can look at is the range of possibilities, okay? And of course, yes, we've got to hold our clients' hands harder through these times than normal, and we have to talk about the range of possibilities going forward, okay? And certainly in this looking glass here, certainly the, you know, the world looks upside down, which certainly it feels to a little bit as well, you know? Okay, so what's this going to look like on the rollout? It's like an alphabet soup, okay, is what I've been telling my clients, you know. Is it going to be a V recovery? Oh, if only. Is it a double? Okay, a W. And is it a double roll down, you know, on that perspective? Is it going to be an L, okay, a U? How is the equity markets going to perform, okay, and roll out? Is it going to be a Nike tick and a swoosh out the other end? Who the heck knows? But of course, we could go back to our previous slides looking at where are the markets right now from an equity perspective, you know. But let's just have a look at some of these as they roll out and what they may look like, okay, and mean to us. Okay, so we're looking at here at, okay, the V-shaped recovery. And I know this is looking at a V recovery. So yes, it's definitely going to be, we're in a recession, of course, but maybe I just liken this to a 9/11 scenario, okay? So of course, obviously, you know, if you were, okay, old enough and working and remember where you were during 9/11, well, I remember I was in Sao Paulo, I was giving a training session, okay, in the brokerage firm down there, and the office in Sao Paulo, the Edificio Dacon, was actually on the flight path coming into the city airport in Sao Paulo. And I remember looking out of the windows and seeing these 737s come bombing in as they would every day. And then, of course, we understood what had happened to the planes in the Twin Towers. And then it was just a very unnerving experience and feeling. But what happened was that the Dow Jones and equity markets fell dramatically. We couldn't get our heads around it. Yes, of course. Okay, shock, horror, sell. Okay. But of course, the euphoric, okay, buyback in the equity markets was dramatic, and it was very quick. Within 2.5 weeks later, the 20% fall was made up and more. Okay, on that perspective. And maybe, okay, just maybe this situation is much more serious because we're going to have maybe 100 countries in recession at the same time. So the likelihood of a V-shaped recovery, I think, pretty unlikely, okay, on that perspective. Let's have a look at a W. What's a W going to look like here for us? Well, we can see here, okay, of course, we're probably about where my mouse is, okay, just circling around about now. And yes, we've had maybe 30% bounce back up from the base, depending on whether it's NASDAQ, whether it's the SMI on the equity markets. But, okay, who knows, of course, where's my mouse gone? Okay, who knows how long, okay, this rally is going to continue, okay, up and to how high, okay, and whether this is going to, okay, have a further protracted, okay, impact when we do realize, wow, 40 million people in the Eurozone out of work, 20 million people in the US, remembering that end of February, the US was at full employ. They had 1 or 2% unemployment, you know, so going from full employ to 20% unemployment, biggest economy in the world, blows my mind, you know. So we'll see exactly the ramifications of that. And for me, it's one of the reasons for the timing of this briefing, okay, is because I believe it's very worthwhile looking at this. And of course, just as I said, many of our clients were communicating with us, okay, in this sort of time with a view to get in, okay. And yes, of course, they've enjoyed for the money that they put in then, they've enjoyed, okay, the biggest rally in history. But just maybe that there is another opportunity coming in 1, 2, 3, 4, 5 weeks. So if you weren't able to get on board with the first roll-up, then of course there could be, okay, a secondary scenario. Could be. I don't know for certain, but maybe that there are some opportunities there if there is, okay, a further roll down. Now, let's look at the L shape here. This is less interesting. And really for me, this could become a reality. If we can no longer travel, if countries have what we call lock-ins, if Spain says no one can come here from a travel and tourism perspective, particularly if you're from the UK, or particularly if you're from a country that's downtrodden and suffered badly and didn't lock down soon enough and didn't go from a big testing emphasis afterwards. Maybe, just maybe, we start to see some economies move into this L-shaped sort of scenario. And let's just look at some of the ramifications here, because this is Nomura, and looking at their worst case scenario, the double black lines, and virtually all of these slides are looking here towards end of 2021, and end of 2021, to be some 50% lower than where we were before. Not a very nice place to be in. And certainly when an event-driven recession goes into a systematic-driven recession, of stagflation, deflation, this is where this could end out, unless we get help from science, unless we get, the economy's back up and running again, Of course, the best case situation up here, is looking to be back up and running again, October, November 2021. But nothing going on but the rent in 2020. This is about recovery 2020, even more recovery in 2021 to get us back to where we would like to be, over that period of time. And let's look at it from a U-shaped perspective. And this was now looking at, the world GDP. So this is including the whole world on that perspective. But this is where they predicted, first and foremost, where this rollout of COVID-19 was going to come to. This is now the reality. So we've now really started to understand this. Q1, Q2, Q3, Q4, nowhere near from the highs where it was before. So again, it's a 2021. This is not a 6, 9, 12 months get out of jail situation. This is going to be running far more deep and crisp across. So then we have a look at the swoosh. Now this is the UK scenario. And of course, what we've got here towards the end of 2020 is obviously the Brexit scenario. So we'll see whether that's actually going to be delayed, whether it will even happen or not, even though Boris is, to quote his words, on his dead body, would it be delayed and would it be rolled over again? Of course, he nearly had to eat his words on that one for sure, But again, nobody knows, but these are just, trajectories to look as we roll out. But the predictability here in the UK, we're looking here at end of 2021 again, and this is from Berenberg, so a different analyst on that side. Now this is where I promised we were going to just do a light comparison from the GFC, which is the global financial crisis. And just to remind us, the global financial crisis was when the banks had their hands in the cookie jars and when they were taking securitized debt off their balance sheet and they were moving it to, different companies. Therefore, making their own company feel and be valued at a much higher price and move it to a much higher credit rating. And also they were labeling, very high credit ratings upon the dirty companies, effectively, with the dirty assets that they, had created. When that went pop overnight, most definitely, and we still haven't caught up with the trajectory that we were on prior to that. So this is the, if I can get my mouse to work, here we go. So we look at the yellow line here, this was the total GDP shortfall versus the trend. So the trend was the orange line, tracing upwards. We've never, bridged that gap. It's a lost, lost growth in gross domestic product. And the initial shock, propagated through extended debt, deleveraging cycle. And of course, that's what got us into the whole quantitative easing stage 1, 2, and 3, the $7 trillion in the US to enable them to be in the state that they are today as the #1 economy in the world. The good news is that this is typically an event-driven recession. That's the better of the two recessions. We've got an event-driven recession, you've got a systematic recession. Provided, and we see here, if I can get my mouse to work again, the yellow line here is the drop-off, that's what we've all experienced. Then we've started to come up, this side of the curve here, absolutely. Of course, what we could really do with is a lot of help from the science. We're going to be coming onto the science in a moment. This trajectory of growth and recovery, is aided and abetted by science. Because if we had the confidence to know and to understand that we're going to be all right on the night, okay, then we can continue to roll. If it's not, okay, we're in more trouble, okay? But from this perspective here, we're seeing, okay, this curve, but we do regroup, and we do regroup at the same trajectory that we were on in the past. So we're not going to have a miss that was always on that trajectory and that strategy, which is the good news. It's going to take time. And as I said, we're probably tracking towards the end of 2021, okay? So for our clients that are saving, that have got longer than a maturity of 2 years, 3 years, 4 years upwards, happy days, okay? For those clients that are obviously looking to mature this year or early next year, then of course I know that we've been in contact with the majority of them and spoken to them and heeded, do they need to move into cautious, or what are the strategies that we need to implement, you know? But very worthwhile looking at on that basis, you know? Okay, the science, okay, if ever. Okay, so we know that science is moving extremely rapidly. Okay, we're very lucky as an organization, okay, being history-ridden, stemmed out of Geneva. We have lots of clients at Novartis, at Roche, okay, we have lots of clients there, okay, in the WHO and the Global Fund, okay, in these prestigious organizations. So it's great to be able to tap into them on our forward planning meetings and just to understand, okay, you know, what are they bringing to the table, and also what their opinions are. But of course, there are brains and powers that be in the University of Oxford. I know up until recently, they had effectively in 4 months done 5 years work upon looking to come up with a vaccine. They went live on human testing, okay, 2 Thursdays ago on that perspective. Also Imperial College London, okay, also very much, okay, in very close, okay, contention for being possibly, okay, the first vaccine providers, you know. Also University of Oxford, not only are they looking to conquer the vaccine, but also they've now dovetailed with AstraZeneca, okay, which is a Cambridge-based organization. And AstraZeneca is going to be, okay, the mother of all companies to produce the vaccine. If Oxford University can crack the code and get the vaccine, then it will be AstraZeneca that will go and make. And of course, they've given the NHS in the UK and other core compatriots, okay, the first orders, okay, coming in from them, providing they can crack it. The US version of that, okay, is Gilead, okay, and they've been all over the press recently in days, and of course we've seen Donald Trump on his many briefings, some better than others, but talking about Gilead and the pace that they are looking to achieve, what they're going to achieve. So I cannot believe personally that science isn't going to help to get us back to normal quicker. I cannot believe that they won't, okay, and they're going to be on our side and they're going to be helping. But of course, if they can't, this is a very different rollout, okay, thereafter. Watch this space. This is a very small man on a very large rock, okay, with a very big crevice. But this slide is designed to show that for our clients, that thought about wanting to step away. So when the equity markets were falling 30%, many of our clients wanted to step off because they didn't want to fall that to the bottom. They didn't want to traverse all the way down. They didn't want to feel that pain. But this example here shows, okay, the 31st of December 2019, a client investing £10,000, and it went into the Morgan Stanley Composite Index World Index, okay? So it's just an equity index. It's got everything in there, all weighted, yeah? Imagine if that client had missed the best 5 days of the market. So the best 5 days, the best 5 bull market days of the equity markets, if we just extrapolated that and we took them out, we substituted their money those 5 days, their 32,000 would in fact be worth 25 days. Sorry, 25,000. Okay. If we substituted the best 10 days, they're down to 20,000, 16,000, 13,000, 25 days. What's happened for the last 25 days? We've seen equity markets rally circa 25%. So just imagine a client had sold at the bottom of the market and they'd stuck it out and they'd put the money in the biscuit tin. They'd stuck it in their building society, in their Migros account, okay? And they haven't got back into the market. Their 32,000, providing they get back in now, it's going to be worth 11,000. It's blown their chances, okay? Because they didn't have the confidence. Maybe they didn't have a broker, okay, to come to speak to say, no, exactly the wrong thing to sell. Do not sell. We didn't make any changes to our portfolios on the way down, but also on the way up to right now. We're only just making the changes now because we think that we need to be a bit more dynamic coming out of this, or if we go into a double dip, okay, in a W, okay, scenario. Okay, just taking that theme on one, okay, section further. This is a slide from Craig's provider, Craig Gardner, who's in charge of our lifestyle financial planning, okay, clients, which is really financial planning, okay, on high quality Red Bull. On that perspective, it's for the clients that want to know when is enough enough. The clients want to know when they're going to run out of money. And in this particular client situation, they're going to run out of money, okay, at 85, 6, 7, 8, at 88 years old. So in this example, providing they pass away before 88, they're going to be okay. The point I make here, though, is this is a market drop. And we've put the same market drop, okay, that we've happened, a negative 30% in equities. And this client here, okay, has got corporate pension schemes, they've got unit trusts, they've got savings plans, they've got equities, etc. Falls 30%, recovers 30%. Let's just suggest that that's the end of 2021 for this particular client. Provided they've got years and they continue to save, my mouse keeps disappearing, and they continue to save and invest over these years, this client retires here, retires at 61, 62. Okay, and then of course they're eating into their investments and their pensions, okay, and this is when they run out of money. But the size of this equity gap here, of course, doesn't bear any scenario with them because, of course, the equity has ended up going on to become, okay, what it was equally worth and more after the event. So it is about holding your nerve. It's about engaging with us as brokers, okay, and taking our advice to maintain invested and to see through that original, okay, retirement goal, okay, coming through in their case at 61, 62. Okay, we've also got lots of our clients are savers, and they save passionately. They save, okay, month in, month out to enable them to achieve their goals. And of course, savers, just like investors, okay, can also get concerned as they start to turn on the BBC and the Bloombergs and the Sky News, etc., and to see the equity markets are in disarray. And this slide, I've really put it in just to provide the ultimate reassurance, okay, for those clients, because these are two, okay, scenarios. The blue line is the first scenario, and this here happens to be over 7 months, okay? So let's say that a client came to us and they wanted to save for 7 months, okay? We don't work with 7 months typically because that's a bank account or an ISA, etc. But if they came to work with us for 7 months, okay, and in this situation, on their first investment, okay, and look at the scenario here, over the 7 months, scenario 1 had purchased 875 units fixed at a price of €4 per unit as a lump sum investment. So they made one-off lump sum here, 875 in, okay, for a unit, okay, and it didn't go up in price, it didn't come down in price. It remained constant, okay. The blue client, okay, started to save, but he didn't make one payment, he made a payment every month. So of course here, he bought 125 units because the price was at 4, okay. The price went up in value. He felt good because he was actually going up in value, he thought, but he only bought 100 units at the top of the market here, yeah? So he bought 100 units up here, and then of course the market started to fall, and it's like, oh shucks, okay, I'm buying 166 units, so I'm actually buying, okay, more units, great, but my price is coming down. Well, here I'm getting more units, 225 units, 225 units, but my value isn't going up. I'm buying, okay, more units, but they're less value. Provided that you stay the test of time, and providing that you get this, and you get this upward tick to all these units you bought down here being worth going back up to 4, okay, euros a unit. The moral of the story is, by investing and saving through a falling market and continuing to be committed to your regular, okay, savings and investments, this client ended up with 1,132 units, okay, rather than 875 units, meaning that, okay, he gained over the blue strategy, okay, over 500 euros, okay, on that basis. So by investing and continuing to save through a falling market is a huge positive strategy, and certainly one you should be really, okay, stuck to like glue. And if you speak to, okay, your wealth managers, then certainly, okay, it will be the same hymn sheet that we'll be singing off on that basis. Okay, resisting temptation. It's what I've talked about. Falling market, you get the willies, okay, you get the fear, okay, you want to pull your money, you know, stick it into the biscuit tin, put it under the, but please resist the temptation. Really important to resist the temptation. Keep going, okay, to the end. Absolutely. Also, okay, the chances, of course, less likely now to be down the pub or in the bar to be able to listen to a colleague, but we have it with our clients. I've heard this, I've heard that, I've taken the advice. Okay, I should never have done that. And of course, we get the situation right now. Is it a sale opportunity? I don't know. If the market's going to continue to go up, yes. If the market rolls down, who knows? Okay, but all I know is this is about time in the market. The only time to invest is all the time on that perspective. Okay, and just to prove on this slide, and please don't think that this is a patchwork quilt, because it certainly looks like it, but this is my penultimate slide. And I just wanted to show you how crazy, okay, it is from an investment perspective. And this shows, okay, every color is a different asset class in a different sector, okay? And I'm just going to pick on, okay, 2016, okay, just because it's where my mouse is, but, okay, emerging market equity was the best asset class to invest in 2016. US equity was the second best. Asian Pacific, global equity, corporate bonds, okay? And we moved down, UK equity, okay, was right down here on the bottom, UK cash, UK property. Wow, 2016, stay away. Why? Oh, Brexit, not surprised there, you know? But then we have a look at it, okay? And let's just pick it up. UK property, the worst asset, okay, in 2016, moves up 2 spots. 2018, it's the best asset in the world to invest in. So we've gone here, 2016, the worst, 2018, the best. 2019, back down the worst. Talk about a roller coaster here. Okay, but what you can start to see, you see the US equity, best investment class 2019, third best, second best, first best, yeah? As you move along here. Okay, fourth best, you know? Okay, so global equity, global equity, global equity. Equity always appears, okay, in the top echelons, the top quartile, okay, of these organizations, of this, okay, asset grid, okay, to take advantage from. You see the black lines as well, very easy to pick out just from a review perspective, but worst, okay, third worst. So cash, okay, not so cool. UK property, 1, 2, 3, 4, pretty negative, bottom 1 or 2 on that perspective. So, of course, it just shows you how hard, okay, it is, okay, to come in to take advantage of the market and to try and pick a winner. That's why you need to have a diverse portfolio with a consistent management tack and go and continue to invest, okay, until the tenure.